Good morning, everyone, and welcome and thank you for joining us on this call today. My name is Johan Barkhuis and I'm the CEO and Chief Investment Officer of Rootstock. I'm joined by my colleague Francois Molan, our Chief Operating Officer and Head Leader. Just to maybe a bit of background, both Francois and I have been with the business since its founding in 2008, and we've been actively involved in the management of the business and also the running of the portfolios we manage. Yeah, thank you for all of those on the call that's actually invested in our funds. Apologies if we bore you with a bit of detail on the background of Rootstock, but we'd like to use this opportunity to give a brief introduction to the Rootstock story. Francois will deal with that. Thereafter, I will follow up with our view on the global markets and where we see opportunities. And then at the end, we'll open up for Q&A through the Q&A tab on Zoom. But maybe just to start, it's been a very exciting journey for us during the past 12 years. We're extremely proud of the successes that we've achieved. We've built a focused, I think quite a unique fund management business, and most importantly, we've generated top quartile performance for our clients, and therefore I think the portfolios that we manage can also potentially be a good addition to your clients' portfolios. So with that, I'm going to hand over to Francois, and he'll give us a short story about Rootstock and the background, and thereafter I'll follow up with the market overview and where we see opportunities. Francois, over to you.
Thanks for the introduction, Johan. Good morning, and thank you to everybody that joined us on the webinar this morning. As Johan said, I would also just like to encourage everybody to please post questions during the presentation. We're going to go through the presentation as quick as possible, and we have set aside time at the end of the presentation where we can hopefully answer as many questions as possible. We will also send the presentation to everybody after the webinar, so feel free to make any notes, but we'll be sure to send you the slide pack afterwards. So let's dive into the formal presentation. And as Johan said, I would like to start with a quick introduction and some background to the business. So Rootstock was founded in 2008 by Taste du Toit after Taste left Coronation Fund Managers, having successfully served as a CEO for more than a decade. The Rootstock business started out as a fund manager for own assets, but very quickly started attracting like-minded, high net worth individuals and family offices that co-invested with us since 2009. After a decade of following the strategy, steadily growing the business and thereby building a very strong foundation for the business, we strategically decided to selectively start expanding into the retail market. But due to the size of our business and the size of our team, we decided to follow a very selective process where, similar to our original target market, we want to engage with a handful of like-minded DFMs, wealth managers, and IFAs to expand into the retail market. And here we are looking for long-term quality relationships where we work together with these partners to manage capital on your client's behalf. Currently, we manage around 4 billion Rand, and we see a very large growth opportunity for the business. This is because of our very low market share in both the worldwide flexible and the global equity fund categories, and because up until recently we had no pure retail funds under management. The solid foundation that we've built over the last decade now allows us to capture this growth opportunity and grow the business with the help of select like-minded partners. Rootstock is still a small business, but we have a very dedicated, experienced and loyal team. And as Johan mentioned, Johan and I have been with the business since its inception in 2008. The Rootstock investment team does original research And the first fund that we launched in 2009, the Rootstock Worldwide Flexible Fund, has delivered top quartile investment performance since its inception. The next slide shows you a quick overview of the Rootstock team. As I've said, it's a small business, and this is the full team. Johan, who you've sitting next to me, is the CEO and portfolio manager of both of our funds. As Johan mentioned, I'm the COO and also the head dealer responsible for the implementation of our investment views in the portfolios. And then we have 3 full-time, highly qualified and experienced investment analysts in Devon Smithers, Francois van Staden, and Harry Botha. Brenda Valentine is responsible for client relations. Danielle is the client and fund administrator, and then Rita and Sonia supports the rest of the team. Ty serves as our chairman, and recently we appointed John Snelham, who used to be the CFO at Coronation Fund Managers, as our non-executive director. So what makes Rootstock unique? Why should you entrust Rootstock with managing a portion of your client's capital? As we all know, there are numerous fund managers, more than 1,000 funds available for investment in South Africa alone. So it is quite difficult to stand out from the pack. But we do, however, think that the Rootstock business and the funds that we manage have unique elements to it that differentiates us from our competitors. Rootstock's motto is to be clear, concise, and uncomplicated in everything that we do. This is evident in how we conduct our business, but also in the way that we think about investments. Rootstock has a very focused investment offering. We manage only 2 portfolios containing our very best ideas, but I will discuss the 2 portfolios in much more detail later in the presentation. We make use of a straightforward investment philosophy and investment process that is easy to understand. And then another thing that makes us unique is the investment process is very transparent and inclusive in nature. What I mean by that is that the whole investment team participates in investment idea generation. Investment research is also presented to the whole team, and the whole team participates in all investment meetings in a very open forum. And the reason we do that is this allows us for vigorous debate where everybody has the opportunity to scrutinize investment research that is produced, ensuring that all risks are taken into account in the investment cases that are presented. Another thing that we think that makes the Rootstock business unique is the way in which the investment team is accessible to our clients. If a client wants to discuss the fund or its holdings, any of the specific shares that we own, or just markets in general, the investment team will always be available to you. This allows clients to directly discuss their investments with the actual decision makers of their capital. And then finally, employees and shareholders are collectively still the largest investors in the fund we manage, thereby creating real alignment of interest with that of our clients. Turning to our investment philosophy, I think that the first of the most important point to make is that equity is our preferred asset class and where Rootstock's expertise lies. We do not invest in bonds, properties, or derivatives, and therefore the asset allocation decision is one between equity and cash, depending on the expected return of our shares and whether that meets our hurdle rates. The investment philosophy has 3 very important legs to it. And the first criteria of investment philosophy is that we want to own high-quality businesses that are very profitable, measured by their returns on invested capital. The second criteria is that these businesses must have an expanding market opportunity in front of them. This allows these businesses to grow for long periods of time by reinvesting their capital at high returns. And then finally, the third criteria is that we look for a margin of safety in the valuation of these businesses when we acquire them. Valuation is very important, and we never want to overpay for a business, but it is important to note that this is our last check rather than our first. So meaning or implying that we are therefore not value investors that would be happy with lower quality investments due to a low valuation. We rather look at quality, profitability, and then growth first, and then finally have a valuation look when we look at businesses. Because there are not a lot of businesses that meet these three stringent criteria, we end up with a very high conviction concentrated portfolio, where we own 20 to 25 quality, profitable businesses, and we like to hold these businesses for the long term. Just quickly looking at our investment universe, so where do we find these businesses that fulfills our three criteria of the investment philosophy? We predominantly screen North American and Western European markets in search of our investment opportunities. We do also look at select other opportunities, and this will include, amongst others, South Africa, but we do tend to find most of our best ideas in the two previous investment universes. We try to remain within our area of competence, and we do invest in geographies, markets, and sectors that we understand. And then finally, we try to avoid small capitalization shares and really look at any business that has a market capitalization smaller than $8 billion. Finally, turning to risk management before I hand back to Johan. Here we follow a common sense approach where we try to avoid the permanent loss of capital rather than focus on statistical risk indicators such as standard deviation or value at risk. We've always had and have a very strong focus on capital preservation. This has caused us to be too conservative positioned historically in the funds that we manage, where we've had too large cash balances where we should have rather have been fully invested. But nevertheless, this is something that we are very comfortable with, especially where we came from the high net worth individual market, where we have a large emphasis on capital preservation. We found that in the past where we've made mistakes, it was because we slightly deviated from our investment philosophy and investment process. So this remains one of the main levers that we have to ensure prudent risk management in our funds, is just to stick to the investment philosophy, stick to the repeatable, robust investment process. It's worked for us in the past over the last 12 years, and we believe that it will aid us in the future. Then the next point, although CIS rules allows us to have up to 10% in a single position, we limit that to 7.5% in the funds that we manage, to ensure that we are never overexposed to any individual business, no matter how optimistic we are on its prospects. Together with the market capitalization limitation of $8 billion that was mentioned on the previous slide, we also have a self-imposed requirement where we would like to be able to liquidate 80% of the fund within 24 hours. Currently, this criteria stands at 100%, meaning we're able to liquidate 100% of the fund in 24 hours. And that stems from the fact that we invest in quite liquid, larger businesses and not small cap shares. And this allows us to act very quickly should capital preservation be the main priority in some kind of adverse event. Finally, all investment views and businesses that we own gets regularly reviewed and updated and closely monitored. Now I'm going to give back to Johan to discuss our view of global markets and where we see investment opportunities currently. Thanks, Johan.
Thank you, Francois. Maybe just a summary of what I'm going to talk about and the sort of views we've got on the markets and where we see opportunities. But yeah, I'm firstly going to start off by just taking a step back and looking at the sort of market recovery that we've seen during the past 18 months and how we think about that. Secondly, we're going to look at, we'll talk a little bit about the inflation and why we don't think that's over the longer term a big concern. And then turning over to the portfolio, and why we still remain quite constructive on the large and profitable technology companies to which we've got quite a big exposure. And then, following up from that, why we think these big companies will continue to grow. And then, some of the exciting new and interesting ideas and opportunities that we've added to the portfolio recently. So maybe just to start off, this is a chart that dates back to 1970, and it basically illustrates the time lag between a market crash happened and the speed of the recovery again. And as you can see, the pandemic that we've experienced recently, the crash has really been very swift, but so has the recovery, where we've recovered in less than 6 months back to the previous highs of the markets. If you just compare that to the global financial crisis in 2008, 2009, it took the markets about 9 to 12 months to actually draw down to the bottom, but then it took another 2 to 3 years to really recover again. There are a number of reasons for this. I think the biggest or the main one is the size and the speed of the stimulus and the support that we've seen injected into the economies, and this has really helped economic activity to firstly recover quite swiftly, and also sentiment and confidence to return quite strongly. If you compare that to the global financial crisis, where there were really sort of structural fault lines and debt levels were too high, and that took quite a bit of time to really work itself out of the system. I think if you look at economic activity, the data or the chart sort of mirrors this quite nicely, and I think that's one of the reasons why we've seen sort of quite high shorter-term inflation. We do, however, believe that inflation is transitory. There has been a lot of pent-up demand. People that couldn't spend their money, that's now able to go out and spend their money again. And then also there were some supply constraints. So if we look at the recent US inflation data, it was very, very high, and I think the highest in the past decade. So we think that will work itself out of the system as sort of supply constraints are overcome and manufacturing picks up again, and then as people sort of normalize their spending, we think that will dissipate over the medium term. But I think the longer term sort of view that we've got on inflation is that inflation will continue to be managed and be under control. And this is quite a high level chart or illustration of the influence of technology on inflation over time. But as you can see in the chart, in 1977, the Apple II computer that was produced 1 megahertz of processing power. In today's money, it cost about $5,700. If we move forward to today, the iPhone 12 that recently was launched produces 9.8 gigahertz of processing power and only cost $800. So on a price per compute basis, you're currently only paying 8 US cents per unit of compute. And it's difficult to comprehend, but over the past 50 years, this means that the cost of this specific technology has actually declined by an average 25% per year. This also doesn't sort of take into consideration the physical size of the equipment that you're using, the electricity or power savings that the technology today uses, and then just the ease of general use. So we do believe that over the longer term, technology will continue to keep inflation under wraps. I think moving on from that to the portfolio, and I think one of the biggest questions that we're being asked at the moment is, you've got quite a big exposure to some of the larger technology companies, and all of them seem very expensive. Why? What's your view on that? And our view is fairly simple. I do agree. If you look at the markets in general, valuations are quite high. If you look at companies on a fairly basic level, and you only look at historical earnings, valuations might also seem high. But if we just look at some of the larger technology companies that we own, and we also look at the potential growth that they can achieve, not only in the next year or two, but over multi-year periods, they actually look very, very attractively valued. As you can see in the chart, this chart just sort of illustrates the growth sector relative to the value sector, and it compares the valuation on the price earnings growth basis. As you can see from the dotted line, during the past 20 years, the growth companies, which is dominated by some of the big technology names, traded at a premium of 30% to your more value-orientated companies. And if you look at today, it's actually only trading at a 10% premium. So in our view, these companies are actually quite attractively valued. I think following up from this, the second question that we get asked a lot is, how does a big company with a $1 or $2 trillion market cap grow from that size? So if you look at the likes of Microsoft or Amazon, both very large companies, it just sort of intuitively feels like it's going to be very difficult for that company to go from a 2 to a 4 to a $10 trillion company. Our view is fairly simple. We think there's actually very big long-term opportunities for these companies, even though they at sort of these very they're already very big companies. And to illustrate that, I just want to talk you through this technology diffusion chart. It's a fancy name, but a fairly simple chart to understand. If we just look at cloud adoption, where Microsoft and Amazon really has quite a big business, today the adoption for cloud technology is only at about 15 to 20%. In our estimation, over time, 90% of compute should really sit in the cloud, just because it's more efficient, it's safer, and it's easier to manage. So if we take that into consideration, we believe that these companies still have a multi-year growth opportunity of 10 to 15 years. And if you just do the math, if you say a Microsoft can grow at 15% for the next 15 years, the numbers really start getting big. So then a $2 trillion company can potentially become a $15 trillion company. So we still believe there's a big opportunity for these companies to grow from already large bases. I think then, following on from that, maybe some of the other interesting companies that we own in the fund, and yeah, I also just quickly want to pause and give a bit of perspective, just relative to the South African investment environment. I think South Africa really has some very good and well managed businesses. And some of them do have longer term growth opportunities. However, unfortunately, many of these businesses are constrained by the realities of the economic environment that we're living in. And in a low growth environment where GDP per capita continue to sort of stay stagnant and decline over time, it's going to be extremely difficult for these businesses to continuously or sustainably grow earnings. And it's really going to come down to a fight for market share where generally profits will come under pressure. But following on top of that, I think South African investors should broaden their horizons a little bit. South Africa does punch above its weight in terms of the size and the sophistication of our financial markets. However, in the bigger scheme of things, our markets are minute compared to some of the markets or the larger sort of opportunities out there. And I think South African investors should look outside of the retail, banking and mining focused sort of listed environment in South Africa. There are much bigger, more exciting opportunities out there. So maybe from that, I'll just chat a little bit about Otis, one of the new additions to the fund. So many of you probably have been in an Otis elevator or escalator. They are the largest elevator company globally, about a 12% market share, and they really are a very profitable business. Maintenance, long-term maintenance contracts makes up a big portion of their profits. As you can see on the right, 83% of their operating profits comes from maintenance and modernization. And why do we like this company? I think there's a rational competitive environment where they operate, and they are a large player. There's a multi-year growth opportunity as urbanization continues to accelerate. Cities are forced to build up and not sideways anymore. And then this business has been neglected over time. It was part of a US-based conglomerate, United Technologies, which also had a number of defense businesses that it owned, and it was recently unbundled. A new management team was put in place. So we really think the right sort of strategy has been put in place, the right incentives has been put in place for this business to really flourish and take back some of the market share that it's lost over the past decade. So on top of that, it's also attractively valued. It's valued at about a 10 to 15% discount to its peers, even though we believe it can grow faster than some of these competitors. So this is just an example of interesting business that we own and meets our philosophy, and yeah, that we're quite excited about. So thank you. I think that sort of concludes my section on the market opportunity and some of the names in the portfolio. Francois is going to end up with a bit more detail on the funds, and then we'll open up for Q&A. Thank you.
Thanks, Johan. So as Johan said, this brings us to the two funds that we manage. And here we will start with the Rootstock Worldwide Flexible Fund that was launched in 2009. The first thing to point out is that this fund has a worldwide flexible mandate, which allows us the maximum flexibility in where and how we allocate capital and where we find investment opportunities. That being said, and as I mentioned earlier, Rootstock are equity experts, and since inception, the average equity exposure of this fund was close to 80%, with the balance invested in cash and cash instruments. The fund currently has 2.6 billion rand of assets under management, and this makes it the fourth largest worldwide flexible fund, behind Coronation's two funds and then the Ford Fund in this category. And the reason I point this out is that I think it's quite important, the size of the fund, because it gives our clients the peace of mind that they will be able to invest and disinvest into this fund without any liquidity constraints. The fund is also one of the few in the worldwide flexible category that has a 10-year plus performance track record. And most importantly, for our clients that have been invested in this fund. This Rootstock fund has been the best performing fund in the category since its launch date in July of 2009. The fund is available on most of the investment platforms, such as Allan Gray. On Allan Gray, it's on the restricted list, but if you request it, it can be made available to you. 91, Momentum, Standard, PPS Investments. And it was also recently included in the Sanlam Glacier shopping list after Glacier did quite an extensive due diligence on the Rootstock business and on the Rootstock fund. And then I think Johan has probably touched on these the last couple of bullets, but we feel that this fund can give you diversification from the larger fund managers. The way in which we manage the fund and the positions we have in the fund looks quite a bit different from that of our competitors. It's a much more concentrated fund, so the risks in the fund are different from the other fund managers, and it gives you offshore exposure while diversifying away from South Africa and the South African rand. Obviously, since inception, it's been used predominantly for discretionary investments. But a lot of our high net worth clients have used this fund where it is available on the investment platforms, and use this fund for living annuities, also for tax-free savings accounts. But with the high offshore exposure, this fund is not suitable for retirement annuities or pre-retirement savings. The next slide shows us the since inception performance of the fund, with the Rootstock fund, the golden line, and the South African CPI plus 5% benchmark in red. And as you can see from the chart, we've been able to perform quite well while minimizing drawdowns and limiting volatility. And that is also important for our clients, not just the absolute performance that we can generate, but how do we do that, and how volatile is it, and what is the risk they take on. The next slide shows the same performance that we look at here on the chart, but only in tabular form. And we've had very positive short-term performance over the 3 months and 6 month periods, where we are up 6.5%, over 6 months we're up 10%. But we always encourage clients or prospective clients to look at the longer term performance to judge our fund management capabilities. And there we are very pleased to have delivered 15.7% investment performance since the fund inception. So that's 15.7% on average per year for the last 12 years. And as mentioned, being the top performing fund over this specific measurement period in the worldwide flexible category. This slide shows the Rootstock Fund's top 10 holdings. This is obviously also available on the MDD, but we are quite transparent, so feel free to contact us to see the rest of the portfolio. As we've said, it's quite concentrated, so currently there's about 25 names in the fund, and we'll be happy to share the full list of them with you. All of these businesses that we own, not only the top 10, but all of them are very high quality, very profitable businesses, and therefore fulfilling our investment philosophy. Many of these businesses we've owned for numerous years, and we intend to hold them for the long term. And then finally, as you will note in the weights of these positions, this is a very concentrated portfolio, but we feel that it is diversified enough. We don't believe that a fund needs 40, 50, 60 positions to be adequately diversified. We rather take high conviction bets on high quality businesses, but it is concentrated, and the top 10 constitute just over 50% of the fund. As I've said, we're going to distribute the slides, so you can have a look in detail at all of these names at your own convenience. Then turning to our second fund, and as mentioned, we only manage 2 funds. They look very similar. They have a similar, what we refer to as a similar DNA, with a very large overlap. I've pointed out the investment mandate of the the Rootstock Worldwide Flexible Fund. But this fund, the Rootstock Global Equity UCITS Fund, was only launched in 2020, July 2020, but it replaced the Tybalt Worldwide Flexible Fund that we launched in 2014. Now, the Tybalt Fund was domiciled in Luxembourg, which was a very expensive jurisdiction, causing unnecessary high fees for our clients invested in the fund. So after a lot of deliberation, we finally therefore decided to replace the Luxembourg Tybalt Fund with the Rootstock Global Equity UCITS Fund, which is a UCITS fund in Ireland, and that enabled us to pass on this cost saving to our clients, where the current management fees is 1.25% flat, without any other fees, no performance fees, etc. This fund, in contrast to the Rootstock Worldwide Flexible Fund, has a global equity mandate, and this means that it must be at least 85% invested in global equity at all times, where with the Rootstock Worldwide Flexible Fund, we do have that asset allocation discretion, although, as I've pointed out, the average equity exposure in the other fund has been about 80%. So again, they are managed in quite a similar fashion. This fund is not as widely available as the as our other fund on platforms, but it is included on Glacier International, Mutual International, Momentum International, and then also on the Credo Wealth platform. As I've mentioned, this fund is only about a year old, so in time we think that the fund would be more widely available on more of the platforms. But what we've done very recently is we've launched a feeder fund on the BCI platform with the name BCI Rootstock Global Equity Feeder Fund, and this enables investors to invest with rands into this Rootstock Global Equity UCITS dollar fund without necessarily having to externalize their funds. So that makes it quite a bit easier for people to get direct exposure to this US dollar fund without having to go through all the hassles of externalizing funds. This is just the performance chart of the Rootstock Global Fund, and unfortunately, by replacing the Tybalt Fund, we are not allowed to quote the performance of the Tybalt Fund when we are referring to this fund, but the performance of the Tybalt Fund is available on request for those of you who are interested in it. But that being said, this fund shows this graph shows the fund performance since its launch in 2020, which is a very short period, measured against the MSCI World Index, which is the line in red. Although we have underperformed the benchmark since inception, predominantly due to large cash balances when the fund was established in July 2020, it took us a bit of time to establish the positions that we wanted to, and that has caused us to be lower in equity than we would have liked, and that cash drag has caused us to outperform during the inception period of the fund. But that being said, we are quite satisfied with the nominal investment performance of the fund over this short time period, and we've seen since we've been fully invested, we've performed quite well measured against the MSCI World Index. This just shows you the same performance figures in table format. Here my comments are the same as on the graph. It is unfortunately a very short period. We are quite happy with the short-term performance compared to the MSCI World Index, but since inception or over the 12-month period, we have underperformed the benchmark due to the cash drag that I've just explained. And then this shows the top 10 holdings of this fund. Again, the full list is available. It's as similarly concentrated as our other fund. It has all the same tickers as the other fund, sometimes in slightly varying weights allocated to them. But as I've said, all the comments I made, the other fund's top 10 holdings is also true here. High quality, growing businesses that we would like to own for the long term. The last couple of slides I'm going to skip. You can feel free to go over them in your own time after we've distributed the presentation. It basically just shows for both of our funds the currency exposure, which is predominantly hard currency and not a lot of South African rand exposure, as well as the sector exposure. And again, both of these look very similar for both of the funds that we do manage. But I'll let you glance over that at your own leisure. And that brings us to the end of the formal presentation. So I'm quite glad that we managed to finalize it in the time that we have. And I think we would like to start with the Q&A now.
Maybe just stop sharing, then we can. Okay, so I'll take the first question. We've got a question on looking at the top 10 holdings. Does it not expose one to undue risks in the tech sector? I think that's a good question, and obviously one that we continuously debate around the sector exposures. But I think I've already touched on some of the reasons why we are quite exposed to that sector. We do manage a concentrated portfolio, so that is a big view that we've taken. And yeah, as I've mentioned, on a relative valuation basis, many of these companies are, in our view, attractively valued. And we do believe they have longer term growth opportunities. That's not to say that there are not risks in the sector. There's been a lot of sort of rumors, or not rumors, but noise around regulation, which we do spend a lot of time on to analyze. But I think for now, those risks are overstated, and probably one of the reasons why the valuations, in our view, look so attractive. But I think, yeah, that's why we've got you have a portfolio, and yeah, the tech sector, or the tech names, make up a portion of the portfolio, even though it's a big portion. There are also interesting other names in the portfolio for which we're quite sort of positive on in terms of their return prospects. Then there's another question. I guess your activity on Facebook would be to remain within your 7.5%. Despite the prospects for Facebook still looking positive, your view on the valuation on Facebook, please. So I think the question there is around sort of price movements in shares, and if and when we go above our model weights. We monitor that quite closely, but we're quite comfortable if a company goes above our model weight, as long as the valuations are still sort of attractive and the return forecasts still meet our minimum return requirements. But on a more specific basis, if we look at Facebook, we actually think, yeah, again, the valuation is very attractive. If we take into consideration the growth opportunity in the online advertising industry, and if you just on a higher level look at where people are spending their time, there's still a huge opportunity to take market share from traditional advertising channels, whether it's cable TV, print, and other sort of channels. So the valuation is attractive. They seem to have quite strong pricing power, where they've managed to increase prices continuously. And we believe, again, there is a multi-year growth opportunity for Facebook. we've got another question on what's your view on South African valuations and opportunities. I think I've answered that to some degree during the presentation, and as I've said, I think there are a number of South African companies that, according to our sort of standards, meet our quality criteria. And yeah, following on from that, a number of these companies are on face value quite attractively valued. However, once you sort of receive that potential re-rating from those cheap valuations, where do you go from there? So again, the question comes down to the longer term growth prospects for those companies, which we think yeah, it's just going to be very difficult to achieve. That's not to say someone like a Capitec doesn't have a multi-year growth opportunity to eat the big banks lunch, but for the rest of the market, it really is going to be a tough operating environment in terms of sustainably grow earnings. So I hope that answers that question. Then there's one more question on the asset allocation decision in the worldwide flexible fund and how you manage the allocation towards different asset classes. For us, this is a fairly, we manage the fund in a fairly simple and straightforward way. The asset allocation decision that we make and that we have is generally between equity and cash. We don't proclaim to be fixed income or property experts, so it really comes down to increasing or decreasing our equity exposure, and the cash portion of the portfolio we try and enhance the yield a little bit by utilizing money market funds. But I think it really comes down to the availability of opportunities and whether those opportunities meet our return requirements. If we don't see that many opportunities and we think the return prospects and valuations are quite high, we tend to decrease our exposure, and vice versa. If there are a lot of opportunities and we think they're attractive, we increase exposure. That's not to say that we get it right all the time, but we are quite cognizant of the risks, and if we just look at the way we manage the risk in the portfolio, the one thing we don't want to do is lose money. So we've always been probably too conservative, and if you look at the returns, we should have been 120% invested over time. Then we've got another question, your view on the rand-dollar currency, and at which levels do you increase your US dollar exposure? So we do not actively manage the currency exposure in the fund. However, we do take that into consideration when we look at our return prospects. And we've got a fairly straightforward view of the rand, and I think over long periods of time, the rand tend to depreciate by the inflation differential between South African and some of the developed markets. So depending on the time period on which you measure it on, the rand has depreciated by between 4 and 6%. So for international businesses, they've got a bit of a, in our forecast, they get a bit of a tailwind where we take the potential currency depreciation into consideration. And then the opposite side of the coin, for South African businesses, it's a bit of a headwind just because of the longer term expectation for rand weakness. But we don't, as I said, don't actively trade the currency and try and generate returns out of that. For us, it's more about on a company basis where the opportunities are. I think if there are no more questions, I think we can conclude. I think we've actually done very well in terms of time. Again, thank you very much for your time. We appreciate the interest in the business, and our doors are always open if there are any follow-up questions or comments. Francois and the team will circulate the presentation to everyone post the meeting, and our contact details will be on there. So please get in touch, and thank you again for joining us. So that concludes the webinar.